You don't have to let everyone run your credit in order to give you these answers, but you do need to have an idea of where your scores are. Okay. So of course, be prepared to negotiate with the dealer, leverage pre-approval offers to get a better deal. And then you can also focus on the interest rate if you want to, but not just the monthly payment. Sometimes people just focus on getting the lowest monthly payment possible. And don't get me wrong, get something affordable, but don't get something where it's... Hey, what's going on, guys? In today's video, we're going to talk to you all about how you can get the best interest rate on an auto loan. Let's get right into it. Okay, so number one is going to be the power of your credit score. Okay, the single most influential factor in loan interest rates is your credit score. Okay. It's actually pretty simple. The higher your credit score, the better the terms are going to be, including a lower interest rate. So you essentially want to aim for a score of about 780 or above to get the best interest rates. Now, that doesn't mean that you can't get great rates. That just means it just really depends on what you're looking for. Some of you all are looking to get something better than 25%, 20%, 15%. Some of you all are looking to get something much better than what you got before. But if you're really trying to get the absolute best rates, usually it's going to be around 650 plus 780 plus. OK, but here's the thing. Your credit score is like a financial fingerprint that lenders use to assess your credit worthiness. The higher your credit score, the lower the interest rate you'll qualify on an auto loan. OK, generally a score of about 780, like I mentioned, or above is considered excellent and will command the most favorable interest rates. OK, also, if you have bad credit and you're looking to get approved for an auto loan nationwide, all you have to do is scan this QR code right here. We also have the link inside the description below. Now, let's say if you've already had a bad credit auto loan, but you think the interest rate may be too high, you can most definitely try to get that lowered as well, too, with no impact to your credit score. To learn more, go ahead and scan this QR code right here, or you can go ahead and click the link inside the description below. Okay. Next is going to be making sure that you shop around and compare rates. Now, this isn't like back in the day, where back in the day, you essentially there was no way to get soft pulls. There was no way to really have a type of conversation without having to get your credit ran. The greatest thing about in today's time is that you don't even have to have a commitment specifically with a certain bank, and they can give you that information just by you asking them the information or by you simply doing a soft pull. OK, but here's the deal. Don't settle for the first offer you receive. OK, get quotes from banks, credit unions, and online lenders as well. OK, you also want to use online loan comparison tools. That way you can kind of see which ones are going to have the best terms. Sometimes the best interest rate doesn't make sense for the person because the term may be too short and the monthly payment may not be affordable. OK, and so sometimes you may have to go with a slightly higher rate because you get a better term, but you can afford that monthly payment. OK, so make sure you make the smart decision by comparing those loans as well. OK, but here's the deal. Don't make the mistake of only accepting the financing offered by the dealership. OK, get pre-approved for your loan by multiple lenders, including banks, credit unions, and online lenders. Also use online loan comparison tools, like I mentioned, to streamline the process quickly and effectively. OK, and you can identify lenders with the most competitive rates. You can also look at bankrate.com. You can call the dealership and have a conversation with the finance person. So there's a lot of things that you can do before having someone take a hard look, or a hard pull, I should say, on your credit report. OK, by the way, guys, if you haven't done so already, make sure you guys go ahead and like, share, and subscribe to this video. OK, real quick, if you haven't done so already, be sure to download our free ebook. You can actually scan this QR code, or you can click the link in the description below. Now back to the video. So the art of negotiation. OK, so in short, you have to be prepared to negotiate. That doesn't mean that it's going to be like hardcore sales. It's really just asking the question and saying, hey, could I get a better interest rate than this? What are the best rates that you have? What are the best terms that you have? And you can do that with a simple phone call. You can stop by a couple of dealerships. You don't have to let everyone run your credit in order to give you these answers, but you do need to have have an idea of where your scores are. Okay. So of course, be prepared to negotiate with the dealer, leverage pre-approval offers to get a better deal. And then you can also focus on the interest rate if you want to, but not just the monthly payment. Sometimes people just focus on getting the lowest monthly payment possible. And don't get me wrong, get something affordable, but don't get something where it's so low, where the payment's so low and the interest so high, but the term is so far out that seems attractive. And like I mentioned, all you have to do is ask. So here's the deal. Once you first get a pre-approval, okay, and this can be with any type of situation, a credit union, a bank, is up to you. And with the favorable interest rate, you want to use that as leverage when you're negotiating with the dealership finance department. So for example, let's say you go to your credit union and they give you, a certain type of interest rate, 10%, 5%, 12%, whatever. There's no right or wrong number. Now that you have that, you can then say, hey, I know, I don't know if you guys can beat this, but I would have no problem doing financing here at the dealership if you can beat this rate, if you can beat these terms. Okay. A lot of times people go into the dealership and they're waiting for the dealership to tell them what their options are versus actually having something in advance and then using that as the dangling carrot, if you will, and say, hey, can you do this? Can you match this? Because at the end of the day, they not only want to sell you the car, they make money from selling the car. They make money from selling, doing the financing. They make money from the back end if you decide to get maintenance or a warranty or a gap or some type of coverage in general. So again, the dealership is going to do whatever it takes to try and earn your business. OK, and then highlight the competitive rate that you already have and be prepared to walk away. This is so key because sometimes people feel like, oh, well, the excitement's there. They just drove a car that's got 100,000 miles less than what they're driving. Everything feels tight. Everything feels new or newer, right? And then they say, well, you know what? Let's just go ahead and move forward. But don't be afraid to walk away, especially if the numbers do not work, especially also if they can't match it or beat it. Remember, the interest rate is what truly matters in the long run, okay? And then also, too, you have to ask yourself how long you plan on keeping the car, because you may be looking to get a situation where the term is 5 years, 6 years, but you may end up trading out of it in about 3 or 4 years. That doesn't mean you have to go with a 3 or 4 year term, but just make sure that it actually makes sense to you, but try to get the best rate possible. Okay. Remember, the interest rate is what truly matters, not just the monthly payment, as I just mentioned. Okay. So next, now also too, let me know your thoughts inside of the comments below. And of course, we always like to get an idea. So if you guys are going into buying a car, or if you're probably watching this after you bought a car, let us know about this, what your thoughts are inside of the comments below. Okay. Now, down payments. Let's go into it. Down payments are going to make a huge difference. Okay. The thing is that a lot of people feel like they don't have to put down a down payment. Now, a down payment, not having to put down a down payment, it just depends on how you're looking at it. Like when you're leasing a vehicle, a lot of times the numbers work out a little better if you do have a down payment, or sometimes that first monthly payment, sometimes that'll offset some costs. But it's not a privilege, not necessarily to have a down payment. But sometimes people may not be in a financial position where they want to put money down. OK, but I will say this. People that are typically financially well off, surprisingly, always put money down just so they negotiate the best terms, and then they use some of their own cash to try to get those numbers closer to what they were trying to do. OK, but in short, larger down payments lower the loan amount and the interest paid because you're borrowing you're borrowing a lesser amount of money. And some banks like that. And then some banks obviously just go for a shorter term. OK, but you want to try to aim for at least 20% down. So let's go ahead and put out the calculator. So let's say, for example, you're buying a car, let's say $25,000. So it's going to be $25,000 times 20%. OK, so that's a $5,000 down payment. Now, if you're not in that position to obviously do that, you don't have to have that amount. But that's a strong number if you want to kind of control some of these numbers. Now, keep in mind, this is the ideal situation. This is what a lot of top FICO high score achievers end up doing as well, too. But again, everyone's situation is different. If you don't have money for a down payment, you still can move forward. There's also incentives that's out there as well, too. So if a car has rebates, rebates, if it has savings, that counts towards a down payment as well too. A lot of people don't know that. If you get that same $25,000 car and it has a $5,000 rebate, that rebate is calculated as if it were a down payment. Okay, so just keep in mind a lot of those things when you have rebates and things of that sort as well. Okay, and consider using a savings or selling an existing car. This will be a trade-in. Okay, now I didn't go too deep into a trade-in, but obviously a trade-in can be a down payment as well. So for example, if your vehicle is paid off and it's worth $7,000, then it'll be close to putting down $7,000, because when you're trading in an asset, there's a little bit of a tax difference as well versus just a raw liquid down payment. So keep that in mind. And then also too, you may have to worry about equity if you have a loan on the car, an open loan. So for example, if you owe $7,000 on your, let's say for example, the car is worth $7,000, but you owe $5,000. So that's about $2,000 worth of equity that would be used similar as a down payment towards the new vehicle. Okay. Now the opposite is true as well. So let's say, for example, same scenario, vehicle is worth $7,000, but instead of you owing $5,000, let's say you owe $10,000, right? So it's worth $7,000, but you owe $10,000. That means you have negative equity. You still can move forward, but that negative $3,000 now has to get carried on to the new auto loan, which is more than likely going to increase the monthly payment. And with today's interest rates in 2024, July, these type of rates are a little bit higher. So that means per $1,000, your monthly payment may be $30 to $32 more per month. So if that's $3,000 with the negative equity, let's just round that number down to, let's just say $30 per thousand. That'd be $30, $60, $90 more per month that you're paying because you had negative equity. Now, there's a lot of ways you can get around negative equity. This kind of goes back into if a car has a rebate. So I'm gonna give you guys a little bit, more math, but don't worry, to be easy. Let's say, for example, the car is worth $7,000. You owe $10,000. We have $3,000 worth of negative equity. So we look at a new car. We look at the new car. You don't have to. You can carry over negative equity on a used car, but carrying over negative equity on a newer car sometimes is easier without you having to put in additional money down. Okay. But let's say, for example, the new car has a $2,000 rebate. Okay. So what's the numbers again? The car's worth $7,000. All right. But we owe $10,000. That's $3,000 worth of negative equity. However, that vehicle now has a $2,000 rebate. You can apply that rebate towards the negative equity. So that's 2 minus 3,000. Now you have $1,000 of negative equity. This is why people go into newer vehicles, especially if they have negative equity or if they have an open auto loan where the numbers are just not working out. Okay. So that's going to play a major role. But the size of your down payment can significantly impact the interest rate you're going to qualify for. A larger down payment translates into a smaller loan amount, which also means that you'll pay less interest overall. Ideally, you want to aim for a down payment of at least 20% of the car's purchase price if you can. If not, it's not the end of the world. This can be achieved through savings or selling another vehicle or a combination of both. Okay. Now, this is where the meat's going to meet the potatoes for real. Okay. It's going to be what the loan terms are going to end up being. You tried everything you could, but where are we ending up at? Okay. And so in short, shorter loan terms typically have lower interest rates. So a lot of people don't know that. This is why when you end up financing a vehicle for 5 years, 6 years, and some states 7 years, you have a higher interest rate. Why is that? Because the bank has to wait longer to get their money. Anytime they have to wait longer to get their money, it's going to be more expensive. I don't know if you guys trade, stock options, but it's the same way. When you have a contract for something a little bit longer, that's going to be more expensive. So that's just usually how finances work, or financial institutions or banks or lending in general. If they have to wait to get their money, the interest is going to be a little bit higher. Longer terms, they're going to offer lower monthly payments, but obviously more interest. But you got to make sense. It has to make sense to you and your current financial budget. So, for example, if you can afford, let's say, the monthly payment that's at 6 years right now, that does not mean that when you get that Christmas bonus or when you get that additional income stream or when you get a raise or you change jobs, whatever, that you cannot pay more, that you cannot refinance, that you cannot increase your current credit score and then refinance for better terms. A lot of times people, they sign one time and they think that it's done. No, that's just what you signed for at that moment. You most definitely can save a lot of money if you follow these steps. Okay. Next is choosing a term that fits your budget without sacrificing too much on the interest. The numbers have to make sense. The length of your loan term, also known as the repayment period, also plays a role in determining the interest rate. Generally, shorter loan terms come with lower interest rates because you're repaying the loan faster. However, this translates into a higher monthly payments. Choose a loan term that aligns with your budget while still offering a competitive interest rate. Okay. So make sure that it makes sense to you as you're doing it. All right. So again, guys, thank you all for watching. Make sure you guys, if you haven't done so already, make sure you guys like this video, share this video, and be sure to subscribe as we have nothing but great content well on the way. Thank you all so much, and we'll see you all in the next video.